The nightmare begins. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, world leaders are in fear as the unexpected is now here. And this is something the political elites did not anticipate, and even worse, they have no answer for. And yet it's about to shatter the economy of a major industrial superpower. And meanwhile, the U.S. equity market is celebrating that we're about to achieve this first ever soft landing. But new data suggests it's going to be anything but soft. Let's over to Bloomberg, where he picked today's story up with a headline: Germany's business outlook unexpectedly sours as expectation index falls to 83.5, as economists thought it would be much higher. And this is a big problem because Germany is a major industrial superpower at the heart of the Eurozone. And where their economy goes, their peripheral nations will eventually follow. And this is a huge challenge because here we're seeing in the U.S. what could be this Renaissance period, this mythical soft landing. And yet Germany is staring at a downward abyss with no answer. Well, the problem is it's well out of their ability to control, as you're about to see, and something they have no answer for. We actually expected a positive first quarter, but with its incoming data, it now looks like it could be a negative growth rate. This from President Clemens Fuest, as he told Bloomberg, the underperformance to a surprisingly weak reading from the services sector. And after the economy shrank between October and December, the results made the first recession since the pandemic, quote, very likely now, he said. And this is something virtually nobody expected. You might remember over the last couple of months, the data in Germany started to turn around a little bit, and everyone said the bottom is in, and now all of a sudden we're seeing the services sector move to the downside. And we told you this is exactly what happens. Where the manufacturing sector goes in an economy, the services sector follows with a lag of approximately 2 to 3 months. Now the challenge is Germany's economy is facing the outright unexpected, something, again, the political elites did not anticipate, as you're about to see, have absolutely no answer to. The challenge here is about to send Germany into a deep recession and drag the entire Eurozone and then the rest of the world down with it. While narrowly escaping that fate last year, Germany continues to suffer from weak global demand and the aftermath of the energy crisis. Now, it's important to understand from the global picture here, Germany's number one trading partner. Well, if you said it's U.S., no, it's China. Well, we know China's economy is not performing well, but there's another issue here that's a big problem for German manufacturers. And meanwhile, everyone's banking on a rebound in consumer spending to revive its fortunes, but that hasn't materialized yet, mainly because of energy and the fact that private sector activity data on Wednesday painted a gloomy picture. Now, the challenge here is German consumers are facing a completely different problem than the U.S. consumers are, and that is high energy costs have really destroyed their spending power. Let's take a look at the U.S. data here, put in comparison to what the issue is in Germany, as we look at West Texas Intermediate crude in blue against total compensation, which is average hourly earnings multiplied by average weekly hours of production, and non-supervisory employees in red. And what happens is when you see wages, again shown in red as total compensation, outpacing the growth in energy, well, you have an economy that's growing and booming. The problem is you get periods where compensation is falling behind energy costs, and next thing you know, the odds are pretty heavy that you're going to slide into recession, as you see here in the early 90s, the early 2000s, the global financial crisis. And of course, what we almost saw was a double dip recession, or a big global recession in 2014 between 2016. Now, here in the U.S., we notice that energy prices have fallen at a faster rate than total compensation. The problem in Germany is the exact opposite has happened there, as energy costs have kept ahead of wages, putting consumers in a period where they just don't have the money to spend in the real economy. But that's not the real issue here. It's puzzling that consumers don't seem to be spending, although their incomes are rising. Maybe that could be something that comes later in the year, but it could also be that if consumers are also feeling increasing uncertainty about their economic situation, and there's the key point, they might hold back on spending and save more. So what is the issue that Germany is really facing here? Well, it has everything to do with their trading partner in China, and of course what it costs to get goods around the world. As Red Sea blockage leads to out-of-control shipping rates, just from zero hedge, as charters now hit $100,000 per day. So as we've noted, in yesterday's show, the German manufacturing sector is still in further contraction, but not as bad. The services sector, as we know, turned into a contraction now. Outlook for the manufacturing sector is bleak. But what is the main driver here? Why are consumers not out spending? It's because they see things are indeed going to get worse before they get better. 1 month ago, when it first became apparent that the Red Sea blockage by Iranian proxies would prove to be a prolonged affair, we warned that Red Sea blockage means a new round of surging cost-push inflation, which got confirmation a few days later when we showed a sudden spike in container shipping rates that use the Suez Canal as a transit choke point. And here you can see one thing that could unleash here is the Chinese stock market. We talk about investment opportunities when things get at deep levels. Now, I talked to the programmer today. He sent me some updated reports. We got to dial them in, but the signals are starting to show up. And that means hopefully here in a few days or more, we'll have exactly what all of you have asked for. Can you show us on your reports when the signals flip so we know just what to invest? We don't want to look through reports right now. We'll look through them later. We want that data today. What are your hottest signals? Well, we got them because one of the biggest ones, as you're about to see, could be in Chinese equities. The last time they were deep at this level, they rallied over 50% in the following 3 months, creating what could be a big boom for your trading account. Now, looking at our CTA Timer Pro report today, it's still at max short levels. And because we run a historical overlay on machine positioning, it gives you an edge that no one else has. And the signals here are outright amazing, as many of our subscribers can testify. Soon, in a matter of days, hopefully, we will have a first page report that shows you when these signals flip, tells you which ones to invest in, and give you that edge you're looking for. As we look at FXI, the other edge we want to see is from our Momentum Timer Pro report, now flipping to one daily buy signal. This is our technical analyst report. It looks at all of those things like the RSI and the MACD and smooths all that stuff out into one clear signal. Here you see one daily buy count. Now, when the machine positioning flips, our subscribers know because they sign up for both of them, they follow the rules, and they get great results, and you can too. In fact, right now, today, there are 3 coupon codes for a free month. Link in the description. Grab them before they're gone and get ready for the updates are coming soon. Because the bottom line now is the Red Sea blockage is a big problem for Germany, despite the best wishes of central bankers everywhere who can't wait to start cutting rates ahead of the record avalanche of elections this year, becoming a huge inflationary headache for global freight. Furthermore, Lodestar reports container spot rates from Asia to the U.S. and Europe continued to soar this week, as any solution from both the Biden regime and other countries on the Houthi rebels looks increasingly unlikely. And again, this is a huge problem for Germany because their number one trading partner is China. And guess what they have to do to get there? You're right, they have to go right by that through the Red Sea. This is a huge problem, and this is causing demand to go to other factories around the world. So we know there's this big resurgence in U.S. manufacturing. We talked about this in yesterday's show. One of the big catalysts of this is rather than transit through the Red Sea and around the world, people are looking home to bring their goods and services to market, and that is a factor here. The problem is Germany is so key, so important that they trade with China that any slowdown, not just in the Chinese economy, but their ability to get goods to China could send their country into a massive financial crisis, and even worse, a depression, because they're already in the manufacturing sector is already in a depression. That's the problem, and anything could tip it over the edge, and that means Germany's looking to respond, but perhaps too little, too late. As Germany inches towards shipping defense mission for the Red Sea as a political reception Sunday, Bundestag Defense Committee Chair said that the mission would involve EU member states frigates providing defensive cover for merchant shipping. The initiative would be under an EU mandate and would drive other nations' vessels as well. This is an attack on the free economy, and it must be countered. And this is important because, again, this is an attack on the free economy because Germany's economy is so highly dependent on trade with China that without being able to get goods there quickly and cheaply. China, who has very little demand now, can look elsewhere. The problem is the German economy cannot continue to stand strong without this. It's on the edge, and this is exactly what we've been waiting for as a potential tipping point to start to pull Germany under, drag the peripheral nations down with it, and then next thing you know, the entire world is staring at the bottom. As the disruption in the Red Sea is taking a measurable toll on German industrial enterprises, exactly the point we've been making in today's show, as shipping times from Asia to Northern Europe has increased 10 days and prices have increased drastically. American automaker Tesla has announced it'll be suspending output at its Berlin plant location for 2 weeks because of component supply shortages brought on by the Houthi disruption of containerized freight shipments. Its locations outside Germany remain unaffected, and there you have it, because the next step, when you see a downward move in manufacturing output, it has a huge impact on the economy because employers do not have an unlimited amount of money to keep workers standing around doing nothing. And here's the challenge, because we know it's coming. Now let's look at the U.S. data here, because this is the Philly Fed Manufacturing General Activity Index, shown in blue, against continued claims, which is something we're going to talk about for the U.S. here in a bit, because as many people look for a soft landing, we're going to make the case that perhaps something much worse is coming. And when you see a sustained downward trend in manufacturing output, what happens is people get on unemployment, and because there's no work, they stay on unemployment. And as demand from their decline in wages filters through the economy, well, that means even less demand and more people on unemployment. This is an issue that's about to impact Germany in a major way. And you can see here in the U.S. data, it happens over and over and over again, suggesting as we see a downward trend in the regional Fed surveys that perhaps continued claims should continue to rise here. If that begins to happen, then any notion of a soft landing goes right off the table. But you can see now the political elites around the world, they didn't anticipate it, and so far they have absolutely no answer for it. And the reality is we're about to sacrifice a major industrial economy if it doesn't get resolved quickly. Because ships already are hauling U.S. cargo in the Red Sea are turning back after reporting explosions, saying no chance are we going to go through there. The shipping giant Metre is now suspending transits in the region for all its subsidiaries until further notice and developing network contingencies. The U.S. previously said vessels carrying its flag should just stay away from the southern Red Sea until further notice, though the decision to sail rests on individual firms. And that means, of course, alternatives are starting to come into play as shipping lines are open to, well, anything, including land bridges, to avoid high seas headaches, because at any cost they need to get these goods to where they need to be, because if the global economy slows down, remember these shippers, they built a whole bunch of new ships during the pandemic, they expanded their capacity, and they need to get their ships full and moving. If the global economy gets into a recession because goods can't get delivered on time and factories shut down, well, the shipping industry is going to be majorly impacted as well, which means they are in a desperate move as well to get things done. And the initial response to the shipping woes in the Red Sea and the Panama Canal was to wait them out. The next move was to reroute east-west trade lanes through the southern hemisphere. Now another alternative is catching on, the use of land bridges. Here we see on Hapag-Lloyd on Thursday introduced a way around the southern Red Sea, where Houthi militants have pledged to keep attacking vessels. The route bypasses the danger zone near Yemen and moves cargo from Jebel Ali port across the Arabian Peninsula to Jeddah, where it will connect with maritime shuttle service. Here you can see this is not an optimal solution at all in terms of capacity, but it will offer another option to the current transit times, especially where alternative routings become excessively long. This, according to the world's number 5 container line, said in an email statement, look, they all realize this is a massive problem that could spread to the rest of the world. And now let's look at the U.S., because we talk about this mythical soft landing. It's never happened in the history of central banking. Now, you get brief periods where it appears that way. And right now, the U.S. equity markets are rallying as Wall Street is cheering the first ever soft landing. But data today suggests that perhaps it's not going to happen at all, and that maybe the soft landings can be a lot harder than most people think. As initial jobless claims bounce back to 1-month highs, as from near 50 4-year lows. Well, when you get to a low at some point, it turns around. But here's the issue as we dig into the report. Initial claims on a seasonally adjusted basis rose to 214,000. That's up 25,000 over last week. But remind you, that is historically very low numbers. The bigger issue is this non-seasonally adjusted. These are the real numbers. Now, they dropped 42,000 from last week, but at 200 and nearly 50,000 for the week, that is a problem number. Now, as we move down to people who are stuck on unemployment, that's now back up to 1.833 million. So you look at the initial claims, we pretty much washed out last week's low number, but look at continued claims. Back up to again 1.833 million on seasonally adjusted basis, but on a non-seasonally adjusted basis, they did drop 64,000, which is great news, suggesting that many Americans were able to find work again. The problem is the number stuck still over 2 million people, and when you factor in all total claims, you're at over 2.1 million Americans on unemployment. And as we noted, the longer people stay on unemployment, the bigger a problem this becomes, not just for the stock market, but for the economy, for everybody, because as they have less money to spend and they still have all of these bills to pay, particularly due to this high interest rate cost, we know the buy now, pay later loans have to restart this month and are going to be here every month thereafter for quite some time, sapping spending power from U.S. consumer pocketbooks. But this could put the stock market on notice as it still looks to go even higher. As stocks rise on bets, the Fed can achieve a soft landing. Of course, that would be the first time in history, as U.S. GDP increased a whopping 3.3% last quarter, capping off what was a strong year, giving investors everything they need to believe that things are great. In fact, there's no recession concerns here, and to make matters even better, we don't see any accompanying blowout growth in prices that are used in the GDP calculations. This from the investment director at GAM Investments. Stronger growth without inflation. Well, that's what everyone wants, and no doubt about it, that is what everyone needs right now, is wages to stay up, growth to be there, and then in turn, inflation to moderate and stay low. Of course, we'll get an update on that later next month, but it's hard to argue the economy isn't strong. Well, it is when we look at the non-seasonally adjusted unemployment data. The stock market will continue to rally as long as the economy stays out of a recession. Well, that's the obvious, and consumers continue to spend. The only question is, can they? And that is even without the Fed cutting rates. After the Fed starts cutting rates, which don't bet on that anytime soon, at least we'll find out next week for sure what the Fed thinks, that will be an additional tailwind to this market, which continues to surprise to the upside. But something that's also continuing to surprise to the upside is those continued claims numbers. And while many people believe the stock market can be immune to this, and possibly it can, if continued claims continues to rise here and more Americans have less money to spend, eventually it leads to a massive decline in the equity markets, as I'll show you here in a moment. But perhaps, maybe the Goldilocks scenario here is a rising equity market brings people back into the workforce as employers look to add, under the belief that the wealth effect kicks back in. We'll see for sure here in a matter of months. But for now, if you look at the Wilshire 5000, this is a total U.S. stock market in blue against continued claims in red. What we can note is periods where continued claims start to rise and just don't go down. Well, eventually the equity market has the ultimate price to pay as it comes down. We can see it again during the global financial crisis. The equity market again attempted a rally as claims started to move higher, and then eventually claims just got out of control. Well, and stocks went to the floor. And we can even look going into the pandemic where claims were starting to flatten out, and then the stock market struggled a little bit before we hit the pandemic. We'll never know exactly what would have happened, but today we can say the stock market followed continued claims higher and now is saying, look, we don't care. We think those claims are going lower. The problem is if those people from the holiday do not get back in the workforce, it means all of this big move in the equity market at some point is going to come unwound in a major way. And it could be, as we now know, led by a complete collapse of the German economy, which then would take down the rest of the Eurozone. And after that, well, the rest of the world, Asia, North America, were all soon to follow. And if these continued claims numbers in the U.S. hold up, well, don't expect the stock market to hold up with it. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.